No, it's been great, and I'm really excited to actually introduce our next keynote. And it's Christoph Zinsser, somebody I've known we've known each other for 8-9 years now at least, and it's been great to see you move through the industry as well. And I'm excited to have you here as a keynote speaker. Incomet, a newer investment firm out of Munich, and you're one of the fund managers and partners in that fund. And I'm excited to have you and present your thesis, how you approach the market, especially in these times. I think it is really important to be a good stock picker, and having a couple hints and tips and ideas on how to do that will be super beneficial. So, Christoph, thank you so much, and the floor is yours.
Yeah, thank you very much, Kai. Hello, everybody. Hello zusammen. We have known Kai and Soar Financial, the team, for many years now. Have been on site visits together, have exchanged thoughts on how to invest and where to invest in the junior mining space. And certainly there are plenty of challenges throughout a mine life cycle. And we thought we take the opportunity today to present a couple of thoughts and ideas of what we look at, what maybe to look out for, and just to make people maybe aware of the areas where there are inherent challenges in the industry. So maybe just a very quick introduction of ourselves, because we think it probably helps to put things into context. So Incomet, as Kai mentioned, was founded in 2017. We are a private company specialized in mining, headquartered in Munich. And the team really comprises of technical people. I'm probably the odd non-technical guy in the team and chosen to make today's presentation. But importantly, and I'm here with Christopher today, he's a mining engineer, and we have geologists in the team, as well as executives that have been running mining operations actually themselves. So, we have a lot of insight in the industry, and what do we do? It's basically three key pillars that make up Incomet. One is, as Kai mentioned, we have a private fund that invests in junior mining companies, smart gold investments. That is one important pillar of ours. Within the team, we also cover advisory mandates for smaller mining companies, both on the technical side as well as on rather financial reporting. And lastly, and probably equally important, we have relatively recently founded our own private exploration company, Arabian Nubian Shield Exploration, ANS Exploration, active in East Africa. And when combining these activities, we feel that we can learn from our investments and apply that in our own company, as well as benefiting from advisory work. So we think there's a lot of benefit we gain from these different fields. That's probably enough about us. And just looking at the key challenges, and we have sort of put together a couple of slides here and group things in basically three key pillars. We've not reinvented the wheel per se, but want to provide our thoughts, and maybe there are some new ideas that might help when making investment decisions. So the first is timing. So timing is a very broad concept, but what we want to focus today is just to look at the right entry and exit points, which may sound very, very basic and obvious, but being disciplined on the timing is obviously a key for success when investing in junior mining companies. The second pillar we want to look at is motives. So basically, whom are you speaking to when you speak to management of a junior mining companies? What is the management motive to actually run a junior exploration company? For instance, is it a team of geologists that are passionate about making a new discovery, or is it mine builders that want to bring the next project into production? And lastly, incentives. They obviously need to support the motive of a management, so it is important to look at that. The key principle, as always, is to seek to have the management and the shareholders and stakeholders aligned as best as possible. So to kick things off, we're looking here at a well-known curve, the Lasant Curve, which has been talked about in many literatures and is often quoted when looking at a mine life cycle. And a challenge that some investors might have and ask about is, it is very difficult to pick the right time to invest. So do I really need to focus on it? Can I not just see through the cycle and pick the right projects, but then stay invested along the cycle? And the answer is not as straightforward, but we would say it is very difficult, because when we look at the timeline, which we have included down here below, and that is indicative, but it's rarely seen that from exploration to actually mine being built and then going into production is less than 20 years. So clearly, when having the timing in mind, investors need to think of their investment horizon compared to the mine life. And on top of that, not all of the projects will obviously become a mine eventually. It's actually only a very small percentage. And there's different numbers floating around, and it's somewhere around 1% of projects that ultimately will go into production. So timing is important. And this doesn't mean that there is not various point in times where you can invest during the mine life cycle, but it is always key to have in mind the long time it does take to actually develop a project. So just to pick two examples, on the very left-hand side of the curve, really early stage greenfield exploration, it can actually take several years until a drill target is defined. Or moving along the curve, going through economic studies, it will most likely take more than half a decade to actually go through all of the economic studies. So again, matching the investment horizon to the mine life cycle and to a given state where a project is obviously key. Just as an example, if your investment horizon is less than 2 years and you want to benefit from a re-rating of a project that goes through the construction phase, obviously investing at the scoping study stage is too early, because your investment horizon won't be able to see you through the point where a company is actually re-rated. The second point we wanted to discuss today is motives. So as I said, for us it's important to understand what is the motivation of a team to bring a company forward. And looking at this chart here, we just wanted to say, first of all, exploration development projects have a high risk of failure and at the same time are very capital intensive. So junior companies are always fully dependent on funding available to them. And that is where there is a balancing field there's a field of tension that needs to be balanced, because on the left-hand side, there is, as I said, significant capital requirements throughout the development phase. And that is why companies will typically have sort of an inherent tendency to take shortcuts. That is not always in a bad way, but it is something to be aware. And on the other side, using as much capital as possible will, even in exploration, systematically reduce the risk by applying industry standard exploration processes. And I think that sort of field of tension that companies and therewith also investors go through is important to have in mind, and to understand, again, as we said initially, the motives of a company. So, just an example to maybe make it a bit more palatable what we sort of try to describe here. So if a company is pushing forward with a drill program and you as investor don't have the feeling that actually the company has yet fully understood a property or have actually done the proper work to define drill targets, that is something that is really a red flag for us, because it means that the drill program may not yield the success that the company is hoping and ultimately the investor is hoping for. So, some simple ways of identifying that is speaking with management, looking at presentations, and just looking at geological maps. And even myself, I'm not a geologist, but I can understand if a company has put enough efforts into understanding a property and actually preparing a lower risk drill program. And the opposite of that is obviously companies being forced to enter into a drilling program prematurely just in order to create news releases and market attention. So that is certainly something to be cautious about. Moving on, with the exploration process, and don't be afraid, I'm not going to go through this slide in any detail, but I think the key here is two things. The first thing is to really understand that exploration is a scientific process, and there is going to be different methodologies applied for different deposit types, and this is not the case that all of these steps will always need to be taken. But in order to minimize risk, companies need to go through a systematic exploration process, and that is due to the capital constraints not something that we always see, and it is something to certainly look out for. And to put it positively, if companies go through this process very rigorously, the risk of exploration can actually be reduced. And the second important point here is the timeline again. I mentioned initially to match, time horizon to or the investment horizon to actually the development phase a company is in. So even here, defining targets and fine-tuning targets and then being drill ready can take several years. So as investor, we need to be aware of that and need to match our expectations to this process, if we don't want to invest in companies that take shortcuts in order to limit the timeline here. And again, this bar chart here on the left-hand side is not a very scientific bar chart, but just looking at the number of listed gold exploration companies, that is data from last year, was around 1,300 globally. And just based on our experience, and you will have had similar experiences, the number of really experienced and successful teams around the world is probably not much beyond 100 teams globally. That's at least our estimate, or best guess, I should say. So it's really a matter of being sure to have spent enough time with the management, in calls or just going through presentations that the company publishes, really trying to understand, if you are picking the right team for an investment in a junior exploration company. And on the right-hand side, we have included this here because we're discussing a lot internally how to identify and how to make a decision after an initial drill program. Has the management that I have before cautiously picked and the project I have picked, has it yielded the results that I was hoping for as an investor? And this is, these are numbers from a study that Canoland Minerals has done recently, something that is available on their website and certainly much more comprehensive than me just talking about it for 2 minutes here. But basically, they have looked at, in retrospect, they've looked at major discoveries and have looked what has the initial drill program yielded in terms of GT meter, so that is grams per ton times thickness. And clearly you can see that you should have at least one, ideally more, significant intercepts in an initial drill program if you expect that the project, the company that you have invested in, is able to make a major discovery. And you can use this also reflecting with management and say, look, you have not achieved this. Do you have good reasons to continue to explore this specific targets? And there might well be good reasons to further do that, but it is an initial screening that is fairly quickly done and gives you an opportunity to question the path forward of an exploration company, really. Looking at development here, again, it's a fairly busy chart in the sense that there's a lot of information there which could probably fill another presentation and discussion. But the key is, again, what we want to say is that mine development, and we are now at the development phase after a construction decision, or after a decision to go ahead and conduct economic studies, where we would expect companies to follow a certain methodology, and there are good reasons to do that. There is an initial concept and sort of pre-feasibility study. There's other terms that are used, scoping study, preliminary economic assessment, and so on. But the key is really to understand that, you know, a company that goes down that path typically wants to have a concept and wants to verify alternatives, and those alternatives are ultimately then, you know, further fine-tuned and actually decided upon in a feasibility study. Only thereafter, you would typically expect companies to go through detailed engineering and then ultimately construction. So, again, coming back to motives, when we invest in project development stage companies, we want to understand and we want to be assured by management that they are willing to follow they're willing to follow a development process that is standard and that covers the key areas of a development stage. And if there are shortcuts that are being taken, be careful as investor. It doesn't mean that there's potentially a good reason for a shortcut, but the team clearly needs to speak for itself by the amount of experience they have had in the past, by the successes ideally they have had in the past. Otherwise, we would always expect that management clearly communicates these milestones and clearly also makes investors aware of potential changes in this process. So, how can you identify the projects that have the best chance to succeed? We have discussed the importance of a team and you know, a team that is willing to follow industry standards in mine development and is able to adapt in changing circumstances. And you know, as an investor, it's important to follow the company, make sure you know you understand the development schedule of the company. You question management if you see shortcuts or changes. Tracking a timetable over various quarters or even years potentially is very enlightening, because there will be changes and there's nothing wrong with that. But it is important, you know, to understand the attitude of management. Are they willing to give updates, and are they wanting to give you know, reasons for changes, which, as I said, are just normal in the industry. And then there is several rule of thumbs that we apply when looking at development projects. One very simple one is if you look at open pit or you know, a future open pit operation, for every 0.5 grams per ton reserve grade, you can you know, afford a one-time strip ratio. And you know, we have plotted existing development projects and producers here on the right-hand side. You can see there's actually quite a few on this line, but there's also a lot of outliers there. And again, it's only a rule of thumb, so it is just to give sort of an initial indication of, you know, the likelihood for a project to succeed. But it might be a tool to actually prioritize between different project developments that an investor is looking at. And it is, you know, as I said, a fairly simple and quick way of looking at it. Incentives. obviously, I mentioned initially, the alignment of shareholders and management team, and we've just put up here an example because we think that's probably the best way of, looking at it and also being aware of the potential issues that arise. So in this example, that is hypothetical, but it is probably realistic, or it can be realistic. So we have assumed an initial private round or a founding round that the management has conducted at 1 cent for proceeds of 150,000 Canadian. That is really to set things up, and that is to set the company up and advance the initial work on the project. And then there's the second round, which is typically done with family, friends, close associates, industry partners, and that round is conducted at 5 cents, and the company raised 500,000 Canadian. And then there's one third private round, and the last round before the company actually conducts the go public financing, and that's around at 20 cents, and the company raises 1 million. And again, these would be potentially to newsletter writers, to brokers that would follow the company to an IPO. And then lastly, there's the IPO financing at 50 cents to raise 5 million Canadian. So you can see that the market cap is or the valuation is shown in the blue boxes. That the founders and management, if they have not participated in any of the subsequent raises, which is what we would typically expect, so there's obviously nothing wrong with having relatively cheap shares initially, because there is a lot of risk at that stage, and management teams need to be rewarded. But we would also, as investors, expect that a management team joins in future raisings. And for this example, we have assumed that was not the case. And just very, very simplistically speaking, the management at IPO would have 38% of the company, while only putting up 2% of the capital. And for the IPO investors, it's obviously the way around. They would have put up 75% of the capital, but would own 25% of a company. And there is a mismatch of risk reward and of incentive. So it is, we think, important to understand that. And again, a simple question that would give you the answer to this question is to ask management at what price they have acquired on average their shares. And again, we're not arguing against the cheap rounds in the financing, but there needs to be a balance between taking risk and leaving enough upside also for investors that would come in at a later stage. So we have just picked two examples, and they're not, they're not. We're obviously not going to disclose the companies. They're real examples. But what it really comes down to is, even an income statement of exploration companies unveils some interesting facts and makes sure that the remuneration is acceptable. And ultimately, as we said initially, it is high-risk capital that is being used for exploration companies. So we would expect that every junior company deploys most of that risk capital in exploration. And that is not always the case. On the left-hand side, there's an example where the marketing, consulting fees, compensation is actually together more than the exploration expenditure. And on the right-hand side, it's again an example of the G&A, the total G&I being actually twice the exploration expenses over a full year. So we've not picked a specific period in time. As I said, these are just randomly picked examples. And again, none of this is per se a fatal flaw. but it is something that we carefully look at and discuss with management teams on, the rationale and really the reasons for that, because it is obviously striking if an exploration company spends more on marketing than on actual exploration. I think people need to be aware of that and need to question the reasoning for that. So I think my time is closely running up, but just some concluding remarks. So on the right-hand side, we have just left a funnel in here, which we have actually in our fund presentation, because we just want to show the number of projects that are actually out there. And these are all of the properties. I think before we looked at a figure which was listed gold exploration companies. These are all gold projects globally. It's 3,500. And of that, it is a very complicated selection process in the sense that there's a lot of things to look at. But equally, if we use some basic, rule of thumbs or some experience from other companies, I think we can be able to narrow down our targets fairly quickly. And it is important, and we have this discussion regularly, is not to say, oh, what am I maybe missing, but actually focus on the companies and the investments that we are convinced about. And I think that's sort of a fairly important message that I think we ourselves always have to remind us, because it is probably human nature to look at what I could miss. So really to conclude, we have highlighted 4 points here. I think this list could go on forever, but it is, as always, important to focus on some key points. The first one is, pick the right company, research companies, look what they have done in the past, look at the management, what have they done in the past, maybe what are they doing next to the current gig or company that they're working on. Don't just blindly follow, recommendations or, newsletter writers, we would probably say. The second is build a portfolio, and that is not only meant, the number of companies to invest in, but equally important probably to look at this mine life cycle and to make sure that you invest along the mine life cycle in areas and according to your investment horizon to make sure that you have a balanced portfolio, and with that, obviously, the greatest chances to succeed. Thirdly, monitor the stocks. Again, probably fairly obvious, but it is something that is equally important. Just stay on track. Invest the time in looking at the news releases, looking at changes in plan, and lastly, as an investor, have an exit plan. So if you look at originally at your investment horizon, think about when you want to exit in terms of timing, but also think about, does my investment horizon actually allow the company to re-rate? So am I able to invest long enough for the company to develop the project further? And with this, I would conclude the presentation and just hope that we were able to provide some additional thoughts and viewpoints. And as always, there's so many things to discuss, and we're around, Christoph and I around today and tomorrow, and more than happy to have a chat. We will put the presentation on our website as well. This is just a sort of a questionnaire that goes into some of those details, and you won't be able to read it here, but we will put the presentation on the website. And again, even after today and tomorrow, happy to arrange a call and discuss if there was any interest. So with this, thank you very much for listening. Kai, thanks again for inviting us. Good for everybody to be here, and I think we have 1 minute left, so probably one question.
Who are the companies you were talking about?
Won't tell. Maybe tonight.
I'll take you up on that. No, fantastic. Christoph, it was a fantastic presentation from what I caught. So thank you so much for your time. And as you said, you'll be around in Christoph as well, like for any questions. Like I saw the questionnaire at the end. It's quite detailed. It's not as easy as people might think.
Yeah, I would agree.
Fantastic. Thank you so much, Christoph.
Thank you.
Thank you.